What's up, everybody? It's your boy G. I'm back with another video. This video is basically going to be talking about the three different market conditions and the conditions on how you should trade them. So the first market condition is a uptrend, which is also known as a bullish market. Bullish means buys. You're looking for buys. And the second type of market condition is a bearish trend or downtrend, which means you're looking for sales. Bearish equals sales, buys, bullish equals buys. And the last market condition there is called consolidation, or also known as a choppy market. And that is the market condition you don't want to trade at all. So I'm just going to go over some examples on how to identify the different trends and when you want to take your entry and look for a possible entry for these type of trades. So first, I'm just going to draw out some things to give examples. When you're in a bullish trend or an uptrend, the market is moving to the upside. So you're looking for buys, like I said. So the market is making higher highs and higher lows. So you are trending to the upside, making this bullish trend. So this here is what a bullish trend looks like. And for an example like that, we can go here. This here is a bullish trend, as you can see. I'll just start here. We're starting at this low point here. Boom, we make a high, we make a low. We make a high, we make a low. We make a high, we make a low. New higher high, new higher low. Higher high, higher low, higher high. And hopefully you get the concept. The trend is continuing to the upside, which is a bullish trend. We're buying in this market. And based off how I trade supply and demand, all we're doing is making demand zones here. Boom, demand zone here, demand zone here. And we're just waiting for that pullback to look for buys to the upside. Also, even here, boom, demand zone. I'll delete this one. And this could be a perfect example. We got this overall trend. All we're doing is waiting for price to break to the upside and pull back into this level. And then we'll look for our entry here. Boom. We'll look to enter here. Stop loss below this level. And we'll be targeting these highs. The highs that it made, or just higher time frame highs to get a bigger risk to reward in this scenario. But this is a bullish uptrend. This is the market condition you want to take a trade in when it comes to looking for buys. Now to the bearish trend, a downtrend. The downtrend is the same thing, but it's just the opposite way. You're starting at a point, you're making a low, then you're coming back, making a lower high. Lower low, lower high, lower low, lower high, lower low, and it's just the same thing. The market is trending down to the downside, which is bearish. We're looking for sales. And so in this instant, let me find an example, a perfect example. This could be a perfect example here. This is a bearish trend, but we just got a massive aggressive sell-off to the downside. Boom, we got this pullback, made a new low, pullback, made a high, made a new low, pullback, made a new high, new low, new high, new low. Boom. This is a bearish trend or a downtrend, as you can see this example. And so based off supply and demand, how we want to look for this trade, we want to look for our supply zone, which would be the candle previous before the aggressive selling. In this instance, boom, this will be our first supply zone. As you can see, we came here, broke this low, we came back, tapped into this zone, no candle closure in this zone, which gave some type of confirmation that we want to go lower since price was rejecting off this low, this level. Boom, we enter this trade right here. This would be our entry point, and this will put our stop loss, and we would target the lows that it made or these external lows based off the higher time frame, depending on however you trade. But that is the market condition, the two market conditions we want to trade. We want to trade an uptrend, and we want to trade the downtrend, a bullish market and a bearish market. Now on to the consolidation or choppy market. This is consolidation or chop is when price is stuck in a support and resistance range and it's just bouncing off the same level. Boom, boom. It's just steady bouncing off this resistance and this support. This is the type of market you do not want to trade. And this is because there's no telling when price eventually will break to the downside or to the upside. So what you want to do is wait for some type of confirmation, or let's say price is about to get ready to break to the upside. Boom, we make this high, we pull down, make this low, and boom, we break to the upside. So to give us some type of confirmation that we're going to continue to come up, we want to see this pullback and then make these new highs to start the new trend. And then once we make these new highs and start this uptrend, this is when we'll look for a demand zone for entry. And same thing for when it breaks to the downside. Let's say we're in this chop range, we finally break to the downside, boom. Now we're looking for this pullback to see if price is going to respect this level that it just broke out of. And now we want to continue this downtrend to the downside. So this is how you trade the chop range. You wait for price to break above or below, and then you wait for this pullback. And once it pulls back, then you look for an entry based off the trend that it's about to make. And I'm going to find an example on here for that as well. Perfect example right here. I wouldn't say perfect, but in a sense. Example right here. We're chopping in this range here, steady making these same highs. And then eventually we break above and then we pull back. Now it's starting the trend that we are looking for. And then ultimately we're chopping in this range again, but we're still breaking above, making new highs, pulling back, as you can see. And we're starting that uptrend. And so, for example, based off trading supply and demand, we're in this chop range here. Boom, this is the chop range. We get this break above these highs here. This will be our first demand zone. We get this first aggressive high, then we get this pullback, but it doesn't come back to our zone. And it breaks up. So now we're waiting for the new zone that was formed, which would be this zone here. So like I said earlier, supply, you're looking for the candle before the aggressive selling. Demand, you're looking for the previous candle before the aggressive buying, which will be the red candle. So all demand zones will be formed based off the previous red candle, which is this one, and that aggressive buying that is taking place. So this what you would draw for your demand. And other instincts, supply zones like this one right here, aggressive selling. So you draw the green previous candle before the aggressive selling, which would be in this case. So this is the supply zone when you're looking for sales, and a red candle is demand zone when you're looking for buys. And as you can see, like I was saying, we broke this range to the upside. Boom, we got this pullback, then come back to our zone. We broke this high, we pulled back again, and look, we got that tap, that retest into that zone, in our zone that we want. So all you have to do is boom, enter the trade here, put your stop loss below this level, and you're just targeting these highs or whatever you're targeting. And as you can see, the trade played out. We kept making these highs, chopped in the range, then we made a new high, pulled back, we might have seen a little drawdown, then boom, TP hit, whatever you're targeting, price kept moving to the upside. We never would have got stopped out because our stop loss is right here under this level. We might have came back and seen some drawdown if you were still holding this trade, but ultimately this trade rose up to the upside. And so this is the difference between the three market conditions: uptrend, which is a bullish trend; downtrend, which is a bearish trend; and the consolidation, the chop range. This is how you trade those different market conditions.